Welcome back to the End of the Day Show. I'm your host, Matt Parker. Today's August 22nd. This is episode 19. Thank you all for listening. Make sure you like, subscribe, and comment on our podcast on all networks. Today's show, I'm jumping into a few quick stories, and I'll get out of your way. But first up, I'm going to talk a bit about the state of pre-seed funding. So Carta put out a report today talking about the state of pre-seed funding, and we'll go through some of the highlights because if you're a founder raising a pre-seed round, this stuff is beginning to matter more and more just in terms of terms and velocity and then the optionalities that you have when it comes to raising a pre-seed round. Additionally, some tea came out in the Twitter X acquisition. So if you remember, Elon Musk purchased Twitter X back in 2022, which feels like almost 10 years ago, honestly, because there's so much that's happened. But we were able to get access, or the information was released on who invested in Twitter X, with what has now become X. So there were some heavy hitting names and funds. It's pretty much the who's who of investing across the board. So we'll talk a bit about that and kind of how these lists are useful and trying to read them and understand who's actually the people that are making big deals happen. Lastly, we'll talk a little bit about economic news. So there's a little bit of information that came out from the Labor Department where they revised the job numbers, which is causing a big ruckus in politics. But I'll stay in my lane as it relates to startups and what that impact has and what the feel is right now for the job market in the startup ecosystem. So Power Pack show today, let's get into it. So starting off the show, Carta put out a report today focused on pre-seed funding, and Peter Walker over there at Carter has been doing really good with data insights. He's been having a lot of charts that are making their ways across the startup and venture ecosystem. Earlier this week, I talked about just the startup shutdowns that are happening. But on a lighter note, they are, reporting now on the state of pre-seed funding. So it consistently looks like safes are continually dominating the early stage funding scene. For any round under $3 million, they are the go-to instrument. And for rounds under $1 million, they were used 90% of the time. And this is something that's obviously changed in the past, I guess you could say, almost decade. I've been around Silicon Valley and in the startup ecosystem for 7 years. When I first started, safes were kind of still in the infancy phases. Y Combinator has made them more famous just with their standard safe documentation. But it looks like that is the trend. If you're raising anything under $3 million, most likely it's going on a safe. What does that mean for founders? That means it's not a price round. So the benefit is you can close those rounds quicker. There's a lot of less paperwork. You can get generic safes off the internet to have signed and documented with your legal team. The other side of that is it isn't a price round. So while you may have a valuation, that valuation does not necessarily carry much weight because no one's being issued shares. Safes then need to convert at price rounds. Post-money safes are the clean favorite, and these make up about 85%. So that basically means that after the money comes in, that's the valuation that is agreed to at that safe if there is a cap. There are typical programs now that might take up to 10% of your company on a safe. And so you have to really watch the terms to see actually what amount of money you're essentially earmarking for an investor at that safe amount. You always want to push for an uncapped safe, right? If you can. That's not always possible depending on the negotiating power and the leverage that you have in the round. When it comes to these safes, 57% have only a valuation cap. 35% have both a val cap and a discount. So discounts come in where basically you're giving that investor a discount on the future valuation of the company. So if they're coming in today with $1 million investment at a $10 million safe, you could give them a percentage discount to where that money is actually worth more in the future because they're giving it to you now. For founders that are raising around $1 million, the medium value cap is holding steady at around $10 million post money. So if you're looking at a $500,000 raise, expect valuations in the 7 to 8 million. And that is actually still higher, right? As much as correction that we've seen probably at the top of the markets when you think about companies that are that have raised these massive valuations in 2021, and they're having down rounds or they're cutting their valuations. The $7 to $8 million range for $500,000 being standard is actually up. I remember when I started my first company, you were kind of, unless you were like one of these hot YC companies, this is 2017, 2018, you would actually be considered a lucky to get $5 million. And $10 million was definitely, you had something going. 15 was out of the park. Now 7 to 8 on the low end, and 10 is median average. So a lot of founders can get a $15 to $20 million pre-seed valuation if they know how to leverage and they have something going for them. Interestingly, small checks under $25,000 have become a bit scarcer recently, with larger checks taking a bigger slice of the pie. What does this mean? Well, this means the angel investors, are kind of going away. And this is kind of unfortunate because you love those check writers, right? You can talk to maybe 30 or 40 people in 2021, and if you close 10 of them at a $25K check, right, that's about $250,000 right there into your round, and you get to distribute that across a broad variety of people. It looks like according to Carta's data, those numbers are dropping, and you're starting to see less of those checks. So you're having to go for bigger check writers, which means you're needing to lean into actual funds or syndicates or groups that can invest in bulk, where they're kind of bringing all those check sizes together, which actually is good for you as a founder, because you don't want to have a disparate large amount of people on your cap table individually when they're only putting in 10, 25K into your company. Moving right along, when discounts are part of the deal, the median sits at 20%, regardless of whether there's also a valuation cap. So that's about the average discount people are seeing, or they're seeing at Carta. And for those still using convertible notes, which are a bit more popular, if you're like in middle America or you're in a secondary market that's not really a venture capital hub, 9 times out of 10, someone's going to try to sign you to a convertible note. Which is not bad. It just has an interest rate, and it looks like these interest rates have ticked up to about 7.8% as late as Q2, compared to 6.8% in Q2 of last year. So you are seeing a higher interest rate on these convertible notes, which work similar to safes, but also have some form of interest that accrues until you get a price round. What does this all mean? Again, this is not legal advice in regards to this. Definitely confer to your legal counsel if you're starting a company, starting a fundraise, or anything like that. But it's crucial to understand that these trends as you plan your fundraising strategy, which is helpful because a lot of times I talk to founders who say, I want to go out and, target angels that can be, impactful to my round. Well, a lot of those angels aren't really cash engaged in investing in your company right now, as they may have been in 2021 when things were a bit more liquid. A lot of those people are pushing their cash into safer investments, and they're not doing a lot of startup investing. So it might not be a good strategy to actually go target angel investors. And also, soft plug, if you're looking for deeper dives into fundraising and how to raise $1 to $2.5 million within 60 days, I did launch a new course on Maven. It is live. I'm taking on 3 lucky founders that I want to participate in this course with me, where we're going to go through a 8-day exploratorium on how do you raise that $1 to $2.5 million from people that aren't necessarily in your network. A lot of times fundraising, a lot of people force it to be, or try to make it this network-based thing, which there is an element to that. But I do think a lot of founders leave a lot of money on the table by not creating a process around introducing new people into their ecosystem that they could potentially raise money from. And so that's what this fundraising course is all about. It kind of goes through all the things that I use when I raised my $2.5 million round back in 2019 from pretty much all investors that I had no previous relationship with. So I'll make sure to link that in the show notes. Check it out. Give me feedback. I do a free webinar every Thursday related to that. Moving on into segment 2, the Twitter X acquisition for backers. So as we switch gears, talking about a topic that's been one of the most, well covered, well documented topics in Silicon Valley history was Elon Musk's acquisition of Twitter back in 2022. And there's some fascinating lists that just came out of who actually helped finance this massive deal. This has been information, and this is something that's really interesting because one of the disadvantages for these large growth deals and some of these bigger rounds that we see happen in Silicon Valley is you really don't know exactly who invested. And so with this particular investment, they included a list because of some, kind of a court case that's happening right now because Twitter X is actually suing media companies for not marketing and advertising. And I think it's kind of causing a reverse, a process that they probably don't want where they're having to share who all is invested in that, $44 billion acquisition. So it includes some of the heavy hitters that we probably already knew about, Andreessen Horowitz, Sequoia Capital, and Fidelity. We also see some individuals who have been close with Elon Musk, like Larry Ellison, but also Prince Awad bin Talal of the Saudi Arabia Fund is also an investor. And we even got to see some celebrities like the notorious Sean P. Diddy Combs make an appearance on this list. So this diverse group of investors shows just how high profile and complex this deal was. It's a reminder of the intricate web of relationships and capital that can come together in these acquisitions. For the founder audience out there, I think it's just an interesting list to look through. Part of the fundraising course that I present is it starts with lists. You got to have a good list of people that could be actively participating in your round. And this is an interesting list. So maybe we'll do a lesson or so on how to use this list to kick up potential leads for your fundraise. But also, maybe you're not raising a Twitter-sized round, you're not raising $44 billion, but just understanding how large-scale these transactions can come together. And even if you're only raising, say, $3 or $4 million, you'd be surprised how many unique investors you need to talk to raise that amount of money, specifically now as we are in a very, very challenging time in terms of fundraising. So it's very interesting to see the time and effort that has to get put in to close these deals. And it's always interesting to see a list because that becomes the cap table of people that are actually believing in the business. Moving on to our third segment, talking about the economic news. Basically, the Labor Department has revised its job report showing about 818,000 fewer jobs were added ending in March than previously reported. This combined with a slowdown in July suggests that the job market might be cooling off. And, how is this relevant? Well, if you are involved in the startup ecosystem, you understand right now the dearth of the market of opportunity. It is very, very rough right now for a lot of people to get opportunities and jobs within startups. And startups hiring, has changed, right, drastically. From that 2021, I was just talking to a friend who, basically left his job, left his big cushy job at a big tech company back in, I believe, 2022 or 2021 to go start an independent business, an investment firm, and was just catching up with him. And he just, shared with me a lot of the same synergies I feel as on the founder side of being a startup founder, raising money when you're not doing as well as you would like. It is a very rough job market to look at if you're having to look at tech as a place. And he was just talking about, the last time he was on the job market before he left his big tech company, they were essentially giving away jobs in Silicon Valley. And most tech companies were hiring anybody with a pulse that could go and work. And now it's completely reversed, right? The job listings are a lot of times very sparse. A lot of times they've already pre-selected someone that they have, they want for the role. They're just listing the role. So it's a very much an insider game. I was just catching up with another friend. He just got another job. This guy's probably had like 6 jobs in the past 18 months, it feels like. And, he was just describing how he got his latest job, which almost doubled his compensation. And it was purely a network play. An old mentor was a friend of a lead on a team at a very large publicly traded tech company, and they needed somebody for his role, and he was a name that got mentioned, and he got the job. So they're very much there. While there are jobs out there, it does feel like most of the jobs are inside of specific networks, as opposed to how it was, in 2021 when it seemed like every tech company was begging people to come work. So we're seeing a very much of a slowdown, it seems like at a wider level, but also at the industry level. Lastly, on a brighter note, talking about another automated tax and accounting startup that has received funding. This company is called Lettuce, which is essentially it plays to the role of a lot of what we've seen in the past, or I've seen because this is kind of my industry, but it does look as though like there are going to be even more of these companies. So this company, what it looks like it's designed to do is help you actually manage your accounting and finance. So managing accounting and finance, everybody has to do it. This one particularly is focused on growing your business. They've built an automated tax and accounting system so that your business of one can thrive. If you're making $100K, you could be overpaying $10,000 in taxes. And it seems very interesting to see that these types of roles or these types of companies are still getting funded. Like I know two off the top of my hand that are doing similar things. And so one of the things that you can learn as a founder when you start to see businesses that look exactly alike, what's happening there is this has clearly been earmarked as a large target market opportunity where investors, because this company was raised $15 million Series A from Zeev Capital, it obviously seems like these investors and this investor thesis around this idea is there's going to be multiple players and multiple winners. So shout out to Lettuce, another tax and accounting startup that is getting funded. We'll continue to track companies that are getting funded throughout the times. But again, I'm Matt Parker. This is the 4 Insights Media Platform. Thank you for listening. Make sure to check us out here on YouTube 4 times a week, as well as on Substack.